Kenya's economy is gradually recovering and is expected to grow 5% this year, but additional external shocks could place East Africa's biggest economy under severe stress. That's according to the latest World Bank economic report on Kenya. Joining us for more insight is Wolfgang Fengler, who is lead economist at the World Bank. Hi there, Wolfgang.
Hi, David.
Give us the context for this. You're talking about 5%, which certainly to us in South Africa sounds to dream of, because our growth is less than half that, or could be less than half that. So 5% sounds optimistic, but there are possibilities of that being threatened by internal and external factors.
David, you summarized it very nicely. 5% is an average growth for Kenya. It's actually below average for East Africa, which grows at 6% and above. And 5% is also the World Bank's projection for emerging economies as a whole and for Africa as a whole. So Kenya is within that average of emerging economies and Africa. And so nothing particularly strong, nothing particularly weak. But as you just mentioned, if some of the shocks that hit Kenya in the past, especially drought, political instability, but also an unraveling in the Eurozone, that could dent the growth prospects of Kenya and of other African countries. And in that scenario, we project 4.1%.
Interest rates were raised in 2011, and inflation is now below 10% from 20%. That's quite an achievement.
Indeed, last year it was a very turbulent year for Kenya's economy, and the economic policymakers had to do what medical doctors would call a severe surgery. And since then the patient stabilized and inflation came down. It's close to 10%, not yet below, but once it goes below 10%, there may also be room for some more lowering of interest rates. So that's that was the turbulence, and that's the renewed stability that came back in 2012 that give also room for this more average positive growth outlook that we have presented today.
You mentioned interest rates there. What is expected to happen to interest rates, and where have they been, the kind of band that they have been in, and where do you expect them to be?
Well, interest rates have been in the range of 20% for bank lending, and currently the CBR rate is at 18%. So that's high, much higher than Kenya's economy has been experiencing, but it was needed to contain inflation expectations and to help bring inflation down to lower levels. And only once inflation goes down below 10%, then there's probably room again for some reduction in monetary policy. Because if you reduce interest rates too sharply, too rapidly, you will get again volatility in the foreign exchange market. You would see a sharper depreciation of the shilling, which in turn would reignite the inflation pressures.
You talk in the report about opportunities in the East African community. Presumably that's the countries around Kenya. You talk about the need to support the increase in manufacturing and exports. How realistic is that, and how much stuff on the ground still has to be done?
Well, David, growth and trade in the region has been growing from a very low base of something like $6 billion a decade ago to now 20 billion. So it is rapid growth from a very low base. But if you look at the developments in other parts of Africa, and especially in Asia, this is how growth engine have started. You start with some regional trade, you have some small manufacturing base, and you build on that. Kenya's weak engine, though, has been manufacturing. The sector as a whole has not been increasing its share of the economy. It's still hovering around 10%. And given that Asia is becoming more expensive, China will shed a lot of manufacturing jobs over the next decade. There's a huge potential for Africa to absorb some of those manufacturing jobs, and Kenya would be in a very good place to benefit from this relocation of jobs and of industries. But in order to benefit, a number of things need to happen, especially infrastructure. Infrastructure, energy, roads, the port are still not at the standard that would allow global companies to relocate into Kenya to start the manufacturing sector on a much stronger footing here.
Obviously, you need capital for these improvements, and foreign investment is one way of getting that capital. What do foreign investors think? What are the signals that they are sending about why they are not investing more, and what would need to happen for them to invest more?
The investors sending two signals. One is a bit more wait and see how the elections will go in Kenya next year, how the overall reform agenda is progressing. So I think there's a muted, moderate, positive sentiment, but still of some wait and see. There has been a lot of capital coming into Kenya, but it's all short term and not being connected and translated into real deals, into factories ultimately. So that's the transition that needs to happen. At the same time, we see investors coming more and more, especially in some service sectors, coming into Kenya, not just because of Kenya, but because of Africa. And Kenya, especially Nairobi, is a very good hub to position your business for Africa business. So Kenya is benefiting in that sense from Africa's growth momentum, but it's following it, it's not yet leading it.
One of the external possible shocks that you mention, or threats to the economy, is what happens in Europe, as I suppose everyone is watching for. A moment earlier in the program, we talked about Mauritius tourists from Europe dropping by about 14%, but an increase in tourists from Africa. And then, of course, Kenya's other major exports, things like tea and cut flowers, obviously exposed to Europe. What else are you vulnerable to?
Well, Kenya is vulnerable through the euro crisis directly and indirectly. The direct effects, as you just mentioned, are the top three exports, especially tourism, which is a service export, and flowers. And tourism has this double dynamics with lower growth expected from Europe, but higher growth from Asia. And so that could still be somehow in a moderate level this year. Cut flowers is more sensitive because the market is very centralized for Europe, for Kenya. So that's the vulnerability. Tea is less vulnerable because Kenya has started to diversify a lot into Egypt and Pakistan, which are now bigger and more important than the UK for Kenya's export in tea. So the direct impacts are probably as manageable as they were in 08 or 09. So manageable, a problem, but not a severe problem. The severe problem would only happen if the euro crisis spreads across the world, and then Kenya would be as much affected as all the other countries that you're covering.
Just to personalize that growth that you're talking about, you also mentioned that per capita income in Kenya for the first time is now above $800 US per year.
Absolutely, and that shows Kenya's and also East Africa's gradual move up that income ladder. Now, $800 by many countries' perspective is still a very poor country. That means the average Kenyan still earns less than $3 a day. But it's a hell of a difference compared to somebody who used to earn just $2 a day. And if Kenya, that's our main message has been all along, and of many other businessmen, Kenya not just needs high growth, Kenya needs continuity in this growth and broad-based growth. And if Kenya was to grow at 6% per year, which it is manageable, but it's short of reaching now, for the next 7 years it would reach $1,000 per capita, which would propel it into a new league of countries, to the league of countries like South Africa and some of the emerging Asian countries. And I think that's the hope for this country, like for other African countries. It's all the potential to do so, but it needs that continuity so that the average Kenyan continues to benefit year by year.
That was Wolfgang Fengler, who is lead economist at the World Bank.